Afternoon, and thank you all for joining our webinar today, Healthcare Check-In. My name is Stacy, and I'll be your moderator. ERISA attorney Larry Grudzien is our presenter. Today's webinar will cover the latest and greatest in health and welfare plans. We will be emailing and posting to our website a full recording of today's slides with commentary. I will be keeping the webinar on mute today to avoid any background noises. We will also pause sporadically for questions. You can use the GoToWebinar toolbar at the right side of your screen under the Questions tab to submit any questions you may have, and I will make sure they are read aloud and Larry will answer them. Our next webinar to keep in mind for your calendar will be Factors of Self-Funding, Evaluating the Pros and Cons, and will take place on Tuesday, March 20th at 1 p.m. Central Standard Time. And you can register for that through our website, benefitexpress.info. And I'll turn it over to Larry.
Stacy, thank you very much. We usually do this seminar once or twice a year. And what we try to do is we try to recap what's happened since the last time. Now, we didn't do this, I think, the latest one, the last one was in February of 2017. So a lot has gone on. Now, one thing I've done this year that I haven't done in previous years, because some people asked for it, all the different developments are cited. It tells you where it comes from, and when available, I have given you a link that you can go to it. So it's something that once you get the slides, you can actually reread and the actual source this comes from. So let's get started. Now, I want to emphasize to you, I'll try to do this in detail, but as we go along and I see if I get a little behind, I have to speed up a little bit, so I apologize ahead of time. So let's get started on this. And the first thing I'm going to talk about is this IRS letter explains effective retroactive Medicare coverage on HSA contributions. Now, this information letter is not new. And it's something that the only reason I have it in there because I get this question at least once a week from one of my clients. And basically an employee, they retire after 65. The person did not enroll in Medicare. They contributed before they retired. They contributed to an HSA, and let's say they sign up at Medicare at 65 and a half or 66, and all of a sudden they get a notice the fact that the IRS, the CMS has actually had a retroactive Medicare enrollment. And all of a sudden they panic, and the fact that they've contributed to an HSA now, they have to take contributions out. A couple things. This is not new. This has been around for a long time. This develops because somebody enrolls after 65, and it could trigger receiving your Social Security benefits. So at the same time you receive Social Security benefits, you have to enroll in Medicare. And there's a 6-month rule in the Social Security rules in regard to that. Now, basically what happens in this circumstances is, yes, you're back enrolled, and what happens, it affects your HSA eligibility to make contributions. So I think you have, as an employer, if you have an employee that's eligible for Medicare, haven't enrolled yet in Medicare, and that's fine. You can stay on your employer plan, but just say if you apply for Social Security benefits, they're going to have you take Medicare, and it's going to go back 6 months. So you have to consider that when you contribute to your HSA contributions. That and when that happens, then for those 6 months you're not eligible, and if you contribute the full amount, which many people do, at the beginning of the year, then you have to take those they're called excess contributions, and you have to take them out. And remember, you have until the due date of your tax return for the year. So for 2017, you have until April 15th of 2018 to remove those contributions and earnings and not to be subject to what's called a 6% penalty, which is indicated on the slide. And when you take those out, there's no, you're not subject to 20% additional tax on non-medical distribution. So you just have to remove the excess and any earnings. And then if you do it before April 15th of the following year, there's no penalty. So that's extremely important, and especially talking to your older workers. And again, this just goes on the detail about what happens when those amounts are taken out. So again, the IRS letter does confirm that the employee's Medicare enrollment made him ineligible to contribute to HSA, and I think many individuals don't realize that. Now, IRS memo rejects purported favorable tax treatment of wellness payments. What happened is that a couple of people were selling this arrangement, and it was a self-funded medical reimbursement plan along with a wellness program. And basically what they were doing in that situation, the wellness program was generating payments that were above and beyond what they were paying in premiums. And so in the first scenario, the employer pays a small after-tax contribution to enroll in the self-insured plan. Enrolled employees who participate in a specified no-cost wellness activities receive cash payments. So as a condition, if you do certain things under this program, you get cash payments back. And what was interesting, the cash payments from the fixed payment program that generally exceeded the after-tax contributions. Under the actuarial analysis, all employees are expected to receive, and in practice, do receive payments that markedly exceed their contributions. And in this situation, what the IRS said, those payments would be taxable. So that's extremely important to understand. So in the second scenario, the employees have an opportunity to enroll by making substantial pre-tax contributions through a cafeteria plan in a wellness program that independently qualifies an accident and health plan and offers no-cost wellness activities. The employees participating in the wellness program also qualify for payments from the fixed payment plan. Again, if you meet the requirements of the wellness program, you're then given payments back after taking account the employee's contributions to both plans and payments from the fixed payment program exceeds the employee's take-home pay without the plans. The excess is credited as tax flex credits under the cafeteria plan. It emphasizes the reference to insurance refers to risk shifting, and because of that, any taxable amounts that are received by the employees would be subject to withholding. Because the average benefits under the fixed payment program markedly exceed the employee's total contributions to that plan, the excess benefits are either paid by the employer or attributable to employer contributions are included in the employee's income. And there's various gyrations to that. And what happens in that situation, they use it as a way of returning cash to the employees to incentivize them under wellness programs. But again, in that situation, if you're receiving cash in excess of what you paid in, those payments would be taxable. So please be very careful. And I've seen both insured and self-insured programs. Also, please remember there's an executive order, and this confused everybody. This was in early in Trump's administration in 2017, and I got a lot of questions in regard to this. About as soon as President Trump started acting and said that he wanted the various agencies to go easy on the various penalties, the IRS came out and said, and what this indicates is the fact, I'm sorry, the law is the law, and until Congress acts, we're going to enforce the law as written. So there's a number of different letters that were released because a number of people wrote to the Internal Revenue Service asking questions about this when Trump acted. And as this says, they note that the executive order directing agency heads with the responsibility under ACA to minimize the law's unwarranted economic and regulatory burdens do not change ACA. So there's a lot of confusions. And the letters explain that the law requires individuals to maintain minimum essential coverage for each month and qualify for coverage exception. So what they said is until further notice, and again, later in the year, 17, the individual mandate was eventually repealed, but the employer mandate is in place until Congress acts for both. They're going to apply the law as written. That's what that says. Now, this right here is a continuing saga. This is the AARP versus EEOC. And if you want to see what the case looks like, it came out in August of 2017. What happened was the EEOC had released regulations back in 2016. And this relates to both the ADA and GINA. And they put limitations on wellness programs about how much could be returned to the employee under wellness programs. And basically, it was 30% of the single premium rate. And what happened is the AARP saw that and sued them. And a federal court in August of 2017 said, the federal court has concluded the EEOC's final wellness regulations are arbitrary and capricious and sent back to the agency for review. The regulations which address the impact of the Americans with Disabilities Act and GINA were effective in 2017. And the court determined that the EEOC had not justified its conclusion that the 30% incentive level is reasonable interpretation of voluntariness, because that's the whole aspect of ADA. If you're going to put a limitation on something, it's got to basically be voluntary. So all wellness programs have to be voluntary. Now, these EEOC regs were very controversial because it countered and was different than what the other agencies had released in 2013 in regard to HIPAA regulations. They put in more requirements, all right? So now what's interesting about this is the fact that court had refused to put an injunction against the application of the regulations. They let them stand. Now, and again, wellness, and I've gotten a lot of questions on this because people see this in the newspaper and I'm wondering what's happening. So during 2017 and 18, as this is going on, the regulations as written are in place. And so there's 2 or 3 different references in my slides in regard to this, because it's a continuing saga. Because eventually, and you'll see this, that the court has required that the EEOC actually write new regulations. So the EEOC has now filed a status report advising the court that it intends to issue proposed regulations by August 2018 and final regulations by October 2019. It added that substantially amended rule that would likely not be applicable to 2021. So everything is in flux in regard to this. Later in 2017, there were a couple of executive orders that, and the reason why there's no cite here, because the various government agencies have released items on this, and you'll see this. And just today, and I haven't read the regulations that came out today, they came out in regard to short-term limited duration insurance. So those regulations are released. But what Trump indicated, he wanted guidance on association plans, what they did, and I'll explain what that means in a few minutes. New guidance came out on short-term limited duration insurance. And this is going to be important because remember, the individual mandate is gone now starting in 2019. So you're going to see various different replacements for individuals to get insurance, and these limited short-term limited duration insurance may be a replacement for some people because they could be a lot cheaper. And lastly, HRAs. The agencies were directed to consider proposed regulations on issuing guidance that would increase the usability of HRAs. Now remember, and I'll be talking about this in a few minutes, there were guidance on qualified small employer HRAs that came out at the end of October, beginning of November, and I'll be mentioning that in a few minutes. So again, all 3 of these have been fulfilled, but it's at the direction of the president. Also, another question I get all the time, and this is an IRS Information Letter from July of 2017. And basically the question I get is that on what situations do beneficiaries under COBRA get an extended period of time? This is nothing new, but I just wanted you to look at it, and because this is something I just got questioned about this today. So the letter explains generally that a covered employee's spouse can receive COBRA continuation coverage for up to 36 months, if the employee became entitled to Medicare benefits before termination of employment. That's an extremely important sentence. Now, what does entitled mean? It means they enrolled in Medicare. So if you have a spouse that enrolled in Medicare and then got terminated, then the spouse and children would get 36 months. If they waited to enroll later, it's a different result, and it could terminate COBRA coverage for that individual, but as a result, the spouse doesn't get 36 months. It gets only 18 months because of termination of employment. So the spouse's maximum COBRA coverage ends 36 months after the employee's medical entitlement or 18 months after termination, whichever is later. So depending on when they became entitled, it's going to extend the period. So this happens every so often, and you should be aware of that. In certain situations, the spouse could be. Now, also, too, for those of you in Illinois, there's also a state spousal continuation rule that says that because of termination of employment or retirement, and the spouse is at least 55, under state continuation, that spouse gets coverage until age 65. So, and I know in my experience that many employers don't know that rule, and they may not understand the fact that they get the longer of the two periods, and you have to elect it. Now, in October 31st of 2017, the IRS issued comprehensive guidance on qualified small employer HRAs. This is something that was part of the Cures Act in 2016. There were no regulations and no guidance before this, so this is the first time we had its substantial guidance. And please remember that this is only for certain small employers. This is a special HRA. It's not subject to ERISA. It's not subject to COBRA. And eligible employers in this situation have to be under 50 employees for the year. You can't be an applicable large employer, and you cannot sponsor any other group health plan, which means you can't sponsor an HRA, you can't sponsor a health FSA, you can't sponsor dental or vision. So the only thing you have is this qualified small employer, and basically what you can do, you can reimburse premiums and expenses, medical expenses. So it's extreme. So it's a very limited plan, but if you're a small employer and you want to give your employees something, but one thing is important, and you'll see this in the next few minutes, is that you have to make sure before you do any reimbursement that you have to get evidence the fact that person has a valid premium and it's for a minimum essential coverage, and for expenses you have to get receipts. But again, only certain employers can have these plans. Eligible employees, former employees, and non-employee owners cannot participate. You can exclude part-time and seasonal employees, but again, if you have a business that has 2 or 3 different divisions, different EINs, but you own all of them, but you're under 50 employees, then you basically have to include everyone. And again, there's a maximum period of 90 days that person can wait. Once they reach 90 days, then they have to be eligible to get a reimbursement. So there's a 90-day waiting period in regard to qualified small employer HRAs, but you can exclude, again, part-time and seasonal employees. Now, what has to happen is that the same terms requirement, the same terms have to apply to everyone. Now, what the guidance came out that said is that you can vary it according to coverage and age, but everybody basically has to meet that requirement of the amounts have to apply to basically everybody, and it can only vary according to coverage and age. That's what they said. So if multiple eligible employees are covered under the same family coverage, again, cannot be limited to a single employee. But again, you can vary it according to coverages, as I indicated before. Now, one thing, basically what you have to do here is that you can reimburse medical coverage, but what you have to do, as what this slide indicates, you have to, that employee has to provide proof that that person has eligible coverage. And they have to provide that proof every month. So initially they have to give you proof that they have other coverage. And as this slide indicates, after the initial proof, which must be repeated annually, and the additional attestation from the employee is required for each request for reimbursement. And that can be done on a monthly basis. Now, there are model forms that you can use that an employer will swear the fact that they have coverage. Dollar limits. The dollar limits are roughly $5,000 for single coverage, a little over $10,000 for family coverage. And you can do any amount up to that. Now, what's interesting about this concept is that depending on how many months that employee participates in your program for new hires, one thing that's very important is that the dollar limits I just discussed, $5,000 and $10,000, must be prorated. So if you have a new hire and you say, well, if you have single coverage, you get $5,000, they get hired in July, they're only entitled to $2,500 of that. And that's something that the employers have to basically police in that regard. Also, what you have to do, you have to, every year, you have to give them a 90 days before the beginning of the year, you have to give notice of what they're going to be available to them for reimbursement. So it says the deadline for the qualified small employer HRAs is provided in 2017 or 18 is the later of February 19th, 2018, or 90 days after the first day of the plan year. So again, if you're planning something in the future, just make sure 90 days before the employees are given notice of what you're going to do under the program. And you have to provide them what the eligibility is, how much they're going to get, and what the terms are. And under the frequently asked questions, the content on the notice, and they affirm that the notice must be furnished, may be furnished electronically. And again, as I indicated before, you can reimburse either medical, dental, and vision expenses or premiums. That's up to you. You can have a run-out period, but just like a health FSA, you have to have substantiation. So, and again, the plan cannot reimburse expenses before they've been incurred. So it's going to be run somewhat similar to a health FSA. And again, what they indicated is that expenses can be reimbursed, can be substantiated using the substantiation requirements for health FSAs. So you have to provide a receipt indicating when the expense was incurred and how much would the expense. So you can't do a credit card or you can't do a check. You have to have an actual expense of what that is. The amount will show up in the W-2 reporting. So it's something that has to be shown on the W-2. And you can have a qualified small employer HRA and an HSA, but again, in that situation, that qualified small employer HRA can only reimburse premiums, not expenses. Just be forewarned that depending on your design of the plan, premium tax credits and other healthcare reform issues, depending on how much you're going to be reimbursing, it could affect the individual's ability to get tax credits depending on what it is. So again, that's something to really, and in the notices, there's a statement in there informing the employees the fact that that could happen. Now, it's very important to run the program properly, because if you don't run the qualified small HRA properly, it could defeat the program. Any reimbursements, if you don't run the plan right, could be taxable to the employees. So again, you have to be very careful, and you have to make sure you run the program properly, because if you don't get reimbursements or you don't do certain things, then any benefits that are paid to the employees, again, could be included in their income. So again, they're warning employees the fact that you have to run this right.
Do you want me to ask a couple questions we received, Larry?
Sure.
Okay, first one, for Aflac accident and hospital policies, can you confirm if it is pre-tax or employer paid that the benefit is taxable?
It is taxable if it's prepaid and if the reimbursements exceed the contributions. So again, not all of it, but some of it is going to be taxable. Now, if it's paid through an insurance policy, the employer doesn't have to do withholding, but the employee should be informed that in some situations, that payment could be taxable.
Okay, great. And then the next one is they just wanted you to spend a little more time on the issue of individual mandates status. So I'm not sure if you're going over that later, but they wanted a little more detail. Oh, great.
Absolutely. Yeah,
perfect. Okay, that's all I have.
I'm going to go through that. So it's not going to be repealed until 2019, but I have a section in regard to that. Okay, let's look at something that's been happening over the past probably 3 to 4 months. Over the past 3 or 4 months, employers have been getting notices from the IRS that they could be subject to the employer mandate penalties because the way they completed the 1095 Cs and 1094Cs. So some employers are getting notices from the Internal Revenue Service, and in there's a proposed penalty that could be imposed, and you as an employer can make a case that that penalty doesn't apply to you. Now, you'll get a letter called a 226J notice informing you of the proposed penalty amount. And then this preliminary letter will include a brief explanation of the code of the mandate, why you're subject to the mandate. And then it gives you a chance, and there's an attached sheet where you basically accept your fate, or you can write an explanation of why you don't think you're subject to the employer, what's called the employer shared responsibility penalty, or the employer mandate. Now, please let me know. Please, I'll let you know. I've done probably 10 or 15 of these, and I'm surprised how many different providers, and I won't name names, who completed 1094s and 1095s got them wrong. A number of mistakes. And the form that is most troubling is that many of them didn't complete the 1094 properly. Certain boxes weren't checked. Now, what you have to do if you get one of these letters, you have to basically draft an explanation and pinpoint why you think the 1094s or 1095C forms were completed improperly, and I've seen a ton of these. But you have to send, and we haven't got a response back from the IRS yet. But you have to explain why you don't think that you're subject to penalty. One of my clients got a $500,000 penalty, and the provider who did the forms did them incorrectly. Certain boxes weren't checked, especially, and I found very common with some of the transitional relief boxes on line 22. The most common areas that I've seen that were not checked properly were the boxes, the transitional boxes on line 22 on form 1094C. And then in part 3, in some situations, the first column where the answer was yes or no, in some situations they were indicated no when the answer should have been yes, that you provided coverage. And in some situations, that transitional relief that were available in 2015 weren't checked. So you have to explain that and do a cover letter explaining why you don't think that you're subject to the employer shared responsibility, but you'll get what's called a 226J letter. And the instructions in there explaining what you have to do in order to oppose the imposition of this potential liability. I put this in there because a lot of my clients are getting those, and the whole reason why they're getting those because whoever completed the 1094Cs didn't do a very good job. So again, the 226 letter provides instructions of how the ALE should respond, and what you have to do. You have to explain why you don't think the penalty does apply. The IRS will acknowledge an ALE's response letter with an appropriate 227 letter. I haven't got that. If after they receive the 227 letter, the ALE disagrees with the IRS's proposed or revised penalty, you can request a pre-assessment conference with the IRS. So again, I'll keep you posted about what happens when my clients get a 227 letter and see if we were successful. But if you get one of those, don't ignore it. Write a detailed letter why you don't think you're subject to it. Now, if you are subject to the penalty, you have to make a penalty payment. So after the correspondence between you and the IRS, you have determined you're liable. The IRS will assess the penalty and issue a notice and demand letter. This payment demand will include a summary of the penalty and the balance due. And again, my clients started receiving these in late November, early December, and it's continuing. All right, let's go on to the next slide. As I indicated before, as part of the Tax Cuts and Jobs Act that was passed in 2017, part of it was the individual mandate was repealed. And there's a site to where you can actually look at the bill. There were several different employee benefits provisions. One is the individual mandate, and as this says, the effective in 2019, the legislation will reduce to zero the penalty associated with the individual shared responsibility, individual mandate. The IRS has indicated that individual returns filed electronically in 2018 will not be accepted unless the ACA's health coverage requirements have been addressed. Now remember, in tax returns, there's been a box, I think on the second page of the 1040 indicating did you have coverage, and that will continue for 2017 and 2018 because the mandate will not, doesn't go away to 2019. There's been a lot of confusion about this area, qualified transportation plans. They weren't eliminated, but employer contributions are no longer pre-tax. So if an employer contributes to the program, both for parking and both for transit, it's going to be taxable. Now, please understand what has not been eliminated is the pre-tax employee contributions have not been done away with. So please understand that. Also, what's been eliminated is the bike benefit has been eliminated. I don't know why they decided to do that, but it's been eliminated. So again, pre-tax employee contributions are still in place, but if the employer is going to make a contribution, it cannot be pre-tax. Other changes have been implemented. Moving expenses for an 8-year period beginning in 2018. Most employees will not be able to exclude qualified moving expenses. During that period, the exclusion and deduction are preserved only for certain members of the military. For meals, what this does, and I'll summarize this, is the fact what they're hitting is that those employers that have cafeterias that pay for the food of the employees. So it says for years after 2017, the legislation repeals allowing employers to avoid a 50% limitation on deductions for food or beverages if the expenses are excludable from the employee's income as a de minimis fringe, because they are provided on a non-discriminatory basis at a facility at or near the employer's place of business. I think there's a lot of tech companies that do this, so I think they're hitting them. Also, for amounts paid and incurred after 2015, no deduction will be allowed for expenses for operating such facility for food and beverage associated with that facility. So again, any employers that are offering a free cafeteria, those days are over. Other fringe benefits effective in 2017, legislation repeals the rule under 274, allows only a partial deduction for certain entertainment, amusement, and recreation expenses, including expenses for facility used in connection with such activities, which is basically on-site gyms. Effective in 2017, the deductibility of employee achievement awards is limited to tangible personal property that denies the deduction for cash. So if if the cash was small, it could be excluded as a de minimis fringe. This goes away starting in 2018. Now, the one that's getting the most buzz is the next one, which is employer tax credit for paid family and medical leave. So far, no guidance has been released on this, and a lot of people have asked me about this. So what happens is the legislation creates a new tax credit for eligible employers providing paid medical and family leave. To be eligible, the employer must have a written program that pays at least 50% of the wages for qualified employees for at least 2 weeks of annual paid and family leave. Eligible employees paying 50% may claim a general business credit of 12.5% of wages, and that's the most important benefit because it's a credit directly against tax. And that's why this has gotten attention. The credit increases as much as 25% if the rate of payment exceeds 50%. Now, what's important is employers should be made aware that leave provided as vacation, personal leave, or other medical and sick leave is not considered to be family and medical leave eligible for this credit. So it's got to be something above and beyond. And I'm waiting for guidance on this to get too excited to see what happens. Also, too, as part of the act, there's inflation adjustments have been now they're using a different mechanism to do cost of living adjustments. They are currently adjusting inflation using the Consumer Price Index for all urban consumers. Will be instead adjusted for the chained Consumer Price Index for all urban consumers. I would imagine it's going to be a smaller number. Here, according to the Bureau of Labor Statistics, which determines an issue CPI, the CPIU is closer approximation to the true cost of living for most consumers and tends to be increased at a lower rate. That's important. And also for medical deductions, part of ACA, they increased it for most individuals from 7.5 to 10. It's going to go back to 7.5 again. Also, on an annual basis, the DOL releases annual adjustments to penalties, and this is something to keep aware of. These are 2018 numbers. This is civil monetary penalties for a full range of benefits, and it's assessed for any actions after January 2nd, 2018. For Form 5500, the penalty has been increased from $2,097 a day to $2,140. This is not a misprint. If you get caught by the DOL not filing your 5500s, the penalties are pretty severe. For group health plans, if you didn't provide an SPC, that penalty has been increased from $1,105 to $1,226. And for violations of GINA, the penalty has gone up from $112 a day to $114. For 401k plans, if you did not give, for plans with automatic contribution arrangements, penalties for failure to provide a notice has gone up from $1,659 a day to $1,693 a day. And there's also another penalty for blackout notices that goes up from 133 to 126. And for multiple employer plans, if you have one of those, you have to file an M1. And for not filing that, the penalty has gone from $1,527 a day to $1,558 a day. And please be made aware that this filing right here is not subject to the delinquent filer program. So there's no way of making that go away. Now, also, what was extremely very late in this, and this is for the 1094s and 1095s and 1095Cs and Bs. Originally, they were supposed to be due by the end of January. And at the last minute, I think it was the end of 2017, beginning of 2018, the IRS released notice 2018-6 that said, well, wait a minute. What we're going to do, we're going to allow employers to give employees those notices instead of January 31st. You can wait until March 2nd. So due to this automatic extension, the discretionary 30-day extension is not available, and no further extensions may be obtained. All right. So again, now remember, if you're filing paper, they still have to give it to the IRS by the end of February. So there's no extension for filing with the Internal Revenue Service. So if you're filing, so the deadline remains February 28th for paper filings and April 2nd, 2018 for electronic filings. You can get a 30-day extension by filing an 8889. Okay. The more important news of that notice was the fact they're going to extend the good faith penalty relief. That applied for 2015 and 2016, which means if you file a 1094 or 1095 that has mistakes in it, they're going to give you an opportunity, a period of time to correct it without penalty. So if you file something with mistakes, you have time to correct it. So you're not going to be penalized if you make a good faith effort to complete the return and there's mistakes. We were afraid that they weren't going to extend this to 2017 because they did it for 2015 and 16. So again, try to get it right, but if there's mistakes, you can correct it and the penalty clock will not be ticking. So this is extremely important news. Stacey, are there any questions?
Yes, I do have a couple. The first, there are many of these letters. A business does not offer any health insurance. We're hit with the penalty/fine of $260,000. Mm-hmm. Does that make sense, Larry? That's what it is.
Well, here's what's important. Remember in 2015, if you had under 100 participants and you're under 100 full-time employees, for 2015, the penalty didn't apply to you, but you still had to file the 1095 and 1094s. And there's a special way you had to check a couple boxes on line 22, and then you answered yes in column A on part 3, and some people miss that. So again, it all depends how large you are. If you're under 100 full-time employees, no penalty applied to you, but you had to make sure you completed the 1094C properly that indicated that you were taking the transitional relief that were available to you, but you had to indicate that on the form. Okay? Any other questions?
One more. It says, review who is required to file a 5500 form if they only provide medical insurance.
You have to file a 5500 if you provide medical insurance and you have, at the beginning of the year, 100 or more plan participants, and these are employee plan participants. So if you have under 100, you don't have to file a 5500, but if you have 100 or more, you have to file a 5500. Please, there's a special exception for small employers. Okay?
Okay, that's all I have.
Okay. Now, this continuing saga in regard to the EEOC versus AARP, the federal court has sent the EEOC final regulations back to the agency for reconsideration after finding the incentive provisions arbitrary and capricious. Has now vacated those provisions of the regulations effective January 1st, 2019. The court's latest decision concludes that proper remedy for EEOC's failure to adequately explain its incentive regulations is to vacate them. The court acknowledged that employers need advance notice to plan for the rule changes. However, it's delayed vacating the rules to 2019. So if you have a wellness program, just understand that the EEOC regs are still effective for 2018, and they go away in 2019, and we don't know what's going to take its place. That's the problem. So also the DOL has proposed broadening the availability of association plans. This is one of Trump's initiatives. The IRS released proposed regulations designed to expand the availability of association plans. What does this mean? It means that, and what Trump is trying to do is allow small employers to get together, form an association for the purpose of buying coverage together and making it easier to do that, because in many states, employers were prohibited from doing that. It had to be a true life association for other purposes. Now, what people understand, this is not going to be easy because the fact that many states have what's called MIWA rules, multiple employer welfare arrangement rules, and there could be some prohibitions against doing this in state law. So even though the feds may allow you to do this, your local state law may have some issues and problems with. So they're making it easier for employers to form associations, but once they form it, and again, these rules do not change the MIWA rules. There may be some state prohibitions against it. I know in New York, California, and Florida, there's some prohibitions against it. So the DOL issued proposed regulations to expand the availability of association plans. It would make it easier for the group or association employers to be considered an employer for ERISA purposes. So there's one filing, one form. There's expanded commonality of interest, which means you just have to be the same, maybe the same industry or the same place of business. You know, the people in the Chicago area or the people in the Milwaukee area can get together, which may not be the case in prior law. So they've expanded those rules. So by allowing an association to exist for purposes of offering coverage, again, this is different than was required, and so they're making it easier for employers to get together. But stay tuned to see if this is going to really have an impact on helping employers offer coverage to their employees. So each association would have a formal organization structure with a governing body. and the employer members would have directly or indirectly controlled the function. So again, local businesses could get together and form associations just to buy insurance. And then proposals would permit only employees and former employees of the employer and their families to participate. If certain conditions are met, it would allow working owners such as sole proprietors and other self-employed people to act as an employer member of the association participating in the plan. So this is going to open up more group health plans to small employers. And then for non-discrimination purposes, it's created, what this slide is trying to say is going to be treated as one plan. Also, just being made aware of the fact that the final disability claim regulations are going to be effective as of April 1st, 2018. These rules were initially in place and they're supposed to be effective on or after January 1st, 2018, but they delayed them because of comments. And now the regulations have been released and are finalized, are going to be effective. So what does this mean? For disability claims, notice adverse determination. So the denial notice must explain the reason for not following a disability determination by the Social Security Administration, but a change from proposal, no explanation is needed for following determinations for other disability benefit payers. The final regulations also clarify that denial notices must discuss the basis for disagreement with advice obtained on behalf of the plan from medical or vocational experts. So it's going to be similar to what is required under medical plans. And in adding a requirement that was not included in the proposed regulations, a notice of denial on appeal must describe any plan imposed deadline for filing a lawsuit, and expressly requiring a disclosure of the plan's deadline aligns with the DOL's long-held views that notices should not specify any deadline that are insufficient under common current claims procedure rules. In addition, especially when there's appeals, voluntary experts often play a role, and similar to that of medical health professionals in analyzing disability claims. The final regulations added vocational experts to the list of individuals who must be insulated from conflicts of interest. The preamble notes that the need for independence and impartiality, not limited to final decision makers, rather includes others who may support benefit denials. So again, those are the same requirements as under medical. In addition, agreeing with comments from some proposed changes relating to participants' review and respond to additional information were redundant and eliminated. And again, in regard to this, make sure if somebody is deciding the appeal, it's got to be someone different than somebody who decided the denial. A plan that relies on new evidence or new rationale in reviewing an appeal must automatically provide the evidence or rationale to the claimant and allow a reasonable time to respond. The DOL had requested comments on whether changes were needed to existing deadlines and tolling rules, but did not adopt them. There's still a 90-day rule, and the final regulations made some other technical changes. Also, the new budget bill that came out a few weeks ago also made some changes to the Cadillac tax and suspends health insurance fee. Under the Cadillac tax, it was delayed to 2020. Now it's delayed to 2022. The health insurer fee, the annual fee that took place in 2014 will not apply did not apply in calendar year 2019. This fee has similarly been suspended for that had been suspended in 2017, but applies in 2018. There's also a 2019. So let's go over that. The annual fee for healthcare insurers that took effect will be not apply in calendar year 2019. The fee had similar been suspended for 2017, but it applies for 2018. So it applies in 2018, not in 2019. Hopefully I didn't confuse you on that one. Also, further developments and regard to the AARP EEOC rules, the court finally received vacated incentive provisions of the EEOC's final regulations. The EEOC objected to the court's judgment and order, arguing that the court lacked authority. The court agreed with the EEOC to extent that amended judgment required that the EEOC issue a notice of proposed rulemaking on a set schedule. And so they're not. The upshot of this slide is the fact that the court left in place the other aspects of the amended judgments, including the March 30th, 2018 for EEOC status report, but they're not requiring them by August to actually release regulations. That's what that says. So it removes the August 31st deadline. So again, this is a moving target. If you are sponsoring a wellness program, be made aware it's in tremendous flux, and the rules under the EEOC are effective for 2018, but they're going away in 2019, and we don't know when the amended regulations are going to be in place. Are there any additional questions?
Larry, I have one more that came in. If an employer has 101 eligible employees and at the beginning of the year has 95 enrolled in their health plan, 80 enrolled in their group dental, and 75 enrolled in their group vision, does that mean they are over 100 plan participants?
No,
so a 5,500 needs to be filed?
No. No.
Okay, great. That's all I have for questions.
They don't take it together. It's for each benefit. So in that situation, you have to have 100 or more in the medical to file the 5,500. Now the problem that they're going to be facing is in the future. If all of a sudden they get 100 employee participants in the medical, and then 100 in the dental, 100 in the vision, then in that situation they may have to file 3 5,500s. So what I would suggest, once you get 100 employees in one particular benefit, you adopt a wrap plan, and you file 1 5,500 for all benefits. But again, if you take them one at a time, when each one gets 100 or more, you have to file a separate 5,500. Okay? Well, hopefully everybody found this seminar helpful. I know we covered a lot. And if anybody has any questions, that's my contact information. Thank you very much, and Stacy, appreciate it, and we'll see you next month.
Sounds great. Thank you, Larry. Thank you, everyone, for joining today.
Bye-bye.